This is Duke University.
Each quarter, Duke University Fuqua School of Business and CFO Magazine survey CFOs around the world. This quarter, 550 CFOs from the US responded, and another 500 from around the world. So more than 1,000 CFOs responded to our survey this quarter. The United States has been recovering from a very deep recession for the past 5 years. The first few years of that was a jobless recovery with very little increase in employment. The last couple of years, employment has picked up and the unemployment rate has fallen, but wages have remained stagnant. So because of this, I'm happy to report this quarter that 70% of US companies say they will increase wages by more than 3%. Consulting industry, tech, manufacturing, healthcare, these are industries where labor market pressures are building to the point where companies feel they have to increase wages enough to attract and retain qualified employees. At the other end of the spectrum, retail, wholesale, communications, media, and even the energy sector expect wage growth less than 2%, because again, just the labor market pressure is not there to kind of force the companies to increase wages. And some of these companies haven't been performing too well financially, so they're unable to increase wages as much as they might like. The US dollar has appreciated significantly in value over the last year. That means the dollar is more expensive, meaning products produced by US companies and sold overseas are also more expensive. So exporters, over the next year, we expect to see softer growth in the export sector in the United States. Now that filters back also, these same exporters are planning to increase capital spending by less than they otherwise would have. Overall, CapEx growth of about 5%, which is a decent number, but not as strong as it might have otherwise been. Right now in the United States, the economic outlook is as bright as it's been since 2007. So US CFOs are very optimistic about the US outlook over the next year. In Asia, the outlook's a little weaker, but still fairly strong. In Europe, the outlook has kind of bottomed out, not too strong, but improving. In Africa and Latin America, unfortunately, the outlook continues to deteriorate, at least over the next year. So if you put it all together, it looks like the United States, and to a lesser extent, Asia, will be the economic engine pulling the world economy along. Merger and acquisition activity will be hot in Asia, okay? Chinese companies, 40%, Japanese companies, over 50% of companies expect to make an acquisition over the next year. Now the reason is these economies are expected to grow a little more slowly, so the companies are trying to buy growth by buying companies outside of their region. Another type of M&A is a restructuring of weaker companies, and we expect to see pretty strong growth of M&A in Europe and in Africa because of that kind of a consolidation of weaker companies. In the US, it's looking like the Goldilocks level. Not too hot, not too cold, just right for the M&A activity. It's more or less a normal level of M&A in the United States this year. The European Central Bank plans to do quantitative easing over the next year. In fact, they've just started it. That means the central bank buys bonds issued by various countries within Europe. When you buy a bond, you push the price of the bond up. That pushes interest rates down. So when interest rates go down, we expect stronger economic growth, and importantly, the economy should heat up enough to actually increase inflation a little bit. Europe has been struggling right on the cusp of deflation, decreasing prices. So the ECB wants to buy bonds, quantitative easing, eventually to stoke inflation. Unfortunately, the CFOs in Europe, they don't think it's going to work. They think it's going to heat up the stock market and the bond market, but they don't think it will heat up the real economy enough to actually spur the economic growth and inflation. So that's it for this quarter. I'll talk to you again in June.